We are conditioned to view cash sitting in a bank account as perfectly safe. The balance doesn't fluctuate, the numbers don't drop, and it feels secure. But that stagnant number is hiding a steady erosion of your actual wealth. Every UK tax resident currently gets a £20,000 ISA allowance each year. It is a strict use it or lose it boundary. If you don't shield your money inside it by April 5th, you forfeit that allocation to keep future gains entirely safe from the taxman. That creates a specific dilemma for 2026. Cash ISA rates have stabilized, offering guaranteed interest returns. But to build real wealth, you have to weigh the comfort of those guaranteed numbers against the historical necessity of investing in the stock market. Your primary financial metric is purchasing power, the actual quantity of groceries, energy, or travel your money can command in the real world. Locking £20,000 into a cash ISA at a 4% yield while inflation runs at 5% means ending the year with less value than you started with. That scenario mathematically guarantees a loss in purchasing power. To figure out your next move, we can look at this quadrant chart. We are mapping capital risk, the chance your actual balance goes down, on the vertical axis, against inflation protection and growth potential on the horizontal axis. Physical cash under the mattress sits right down here in the bottom left. Your capital risk is virtually zero, but it offers zero growth, leaving it highly vulnerable to inflation. A cash ISA steps up slightly. You get a moderate bump in growth from the interest rate, but you are still pinned very low on the risk axis, meaning you are barely keeping pace with rising costs. Now look at the broad stocks and shares ISA. It jumps into the upper right quadrant. You are accepting a moderate to high level of capital risk, but in exchange, you gain high growth potential to protect your purchasing power. Push further out and you hit single stocks and cryptocurrency. Here, you max out both the growth potential and the capital risk. Notice how you are forced to move across this board. There is no magic corner where you get high growth with zero risk. Avoiding market risk entirely just means you are choosing to maximize your inflation risk instead. Opening a stocks and shares ISA means you are explicitly agreeing to a trade. You surrender short-term certainty on your account balance to secure long-term protection against the rising cost of living. An ISA is simply a tax-free wrapper or a secure box. While the government ensures any growth inside this box remains untouched by the taxman, the actual returns depend entirely on the specific assets you choose to pack inside it. The most common and lowest effort way to fill that box is with a broad global tracker fund. Looking at this comparison table, the inputs for a broad tracker are incredibly light. You spend 5 minutes setting up a monthly direct debit into a fund that owns a tiny slice of thousands of companies worldwide, and your required effort drops to near zero. The outcome is a highly viable long-term strategy. You automatically capture the average growth of the global market without ever needing to read an earnings report or check financial news. But here is the trade-off. You are buying the average, which means you forfeit the chance to wildly outperform the market. You also have to absorb standard economic turbulence. When global markets dip by 10%, your tracker fund will dip by 10%. The success of this strategy relies entirely on your psychological discipline to ignore your portfolio on red days. You agree to sit through inevitable baseline market crashes. That discomfort is the exact price you pay for a low-maintenance wealth-building system. The second way to pack your ISA box is as a single stock picker. We bring the table back, and the required effort shoots to maximum. You are actively reading balance sheets, evaluating leadership teams, and deciding exactly when to buy and sell shares of individual companies. If you are right, the outcome is highly appealing. A single company stock can double or triple in a year, and inside the ISA wrapper, you pay zero capital gains tax on that massive run-up. The volatility goes both ways. The trade-off is a massive drain on your time. You are competing against algorithmic trading firms and institutional analysts. It requires intense research and an emotional detachment from heavy, isolated losses. Decades of market data show that the vast majority of active stock pickers severely underperform a basic index fund over a 10-year stretch. The allure of a massive tax-free windfall is strong, but the statistical reality makes this approach highly inappropriate for most regular investors. Regardless of which approach you take, there is a silent threat living inside these accounts: compounding fees. Many legacy platform providers or actively managed funds charge 1.5% or more every single year. That sounds like a decimal point rounding error. It is not. This dual line graph projects a single £20,000 investment growing over 20 years. The top line uses a low-cost tracker platform charging 0.2%. The bottom line tracks the exact same market performance, but it is eaten alive by a 1.5% platform fee. You might be getting a premium user interface or access to an exclusive fund manager, but over the decades, that convenience will cost you tens of thousands of pounds from your final balance. The entire point of an ISA is to shield your money from the government taking a cut. If you allow unchecked platform fees to compound, you are effectively letting a broker take the cut instead, destroying the exact tax-free benefit you signed up for. Financial hype on social media is irrelevant. The right vehicle for your money depends entirely on matching a specific account to your exact personal scenario. This decision tree flowchart filters out exactly who should avoid a stocks and shares ISA. It starts with one diagnostic question. When do you absolutely need to spend this money? If your timeline is tight, you are exposed to sequence of returns failure. That is a scenario where a severe market crash occurs the exact month you need your cash to pay a deposit or clear a bill. If you are a short-term saver, say buying a house or paying for a wedding in 2 years, you follow the left branch. It drops straight down to a cash ISA. Do not put money you need in 24 months into the stock market. Opt out of the equity hype entirely. Maximizing your potential return is entirely useless if your short-term timeline forces you to sell your assets at a 15% loss just to meet a real-world deadline. If your timeline is over 5 years, you face a second diagnostic question. Will a 20% temporary drop in your portfolio value cause you to log in and panic sell? If the honest answer is yes, you follow this path. Stick to low volatility bond mixes, or stick with the cash ISA. But if you can answer no, you fit the profile of the time-poor wealth builder. Your path drops to the final box, the broad stocks and shares ISA. For this profile, spending an hour comparing platforms and setting up an automated global tracker involves a bit of upfront friction, but that friction is massively outweighed by the mathematical advantage of letting your wealth compound for decades, entirely free from taxation. And if you are a tax optimizer weighing this against a pension, the ISA retains one distinct advantage: complete liquidity. You can withdraw your money at age 40, 50, or whenever you need it, with zero age-based penalties. Ultimately, a 2026 stocks and shares ISA is a highly effective tool for long-term purchasing power, but its value to you relies entirely on honestly auditing your timeline and your stomach for risk before you deposit a single pound.